Thanks. So the way we're going to run this panel is we're going to have Bandi Zondo from SBG Securities. He's the executive head of financial sector equity research. He'll be kickstarting our panel discussion with a presentation on the listed property sector with a view to unpacking what's played out over the sort of last 18 to 24 months and looking ahead to 2020. So Bandi, I'll hand over to you for the presentation, after which I'll invite our other panelists and introduce them to the panel.
My name is Bandi Zondo. I'm a listed property analyst at Standard Bank, and I've been asked to give a view on what our thoughts on the listed sector over the next 18 months or so are. So just a quick disclaimer on my side. I see a few familiar faces here, some executive of the listed property companies who don't always agree with our view and don't like what we say. So just so you know, it's nothing personal. And the investment market that we normally service tends to do the exact opposite of what I say. So don't you worry. So just to kick off the discussion, I mean, these are the key themes. It's no secret that South Africa is facing a few challenges. Our view is that the sector actually offers quite attractive yields at this point, but probably fairly priced. It would be too early to argue that it's cheap at the moment. There are very limited upside catalysts. And our economists and political analysts, the Standard Bank feels that it's going to be a Cyril reform-driven agenda to get back South Africa on the growth path that's needed. In our view, you need about 2% growth in GDP just to keep things stable, or at least have a positive sentiment in the sector. A big talking point last year was Edcon. And for now, risks appear to have been well managed by most of the landlords. However, a big discussion point, given how tough it's been in South Africa and the sector trading at discounts to net asset value, is that a lot of people are talking about M&A activity. And we see that as likely, but not too many deals expected given the current macro backdrop. I think investors are actually waiting for some policy certainty before they can execute on some deals. However, the sector is fairly well diversified. Actually, if you look at the South African listed property sector, only about 55% is South Africa. The rest is offshore, which is quite interesting, and one of the most diversified sectors in the equities market in South Africa. And an important thing with property, and something we'll show, is that a lot of the return is actually in the yield and not capital. And given where yields are, it's actually worth having a look at this point. Yields are probably starting to bottom at these levels. And then obviously there's improving governance. I know that the SA REITs committee is busy with the second edition of the BPR, which we'll touch on briefly. Okay, so just to give you a summary of the performance. The chart on the bottom just shows how listed property has actually struggled over the past 18 months. So if you look on a long-term basis, the sector has provided in line with equities, having done 12.6% over a 10-year period. Now, if you were to strip out NASPERS on the equities side, you actually find that property has actually outperformed most major equity classes. However, over the last 3 years, you can see that the sector struggled down 2.6%, and year to date, it's still obviously reflecting the current weak economy. This was triggered by a big sell-off in what used to be called the Resilient Stable, which is a resilient group of companies. And later, as time went on, it became quite clear that South Africa is not on any growth path. And obviously, the trade war with the US and China all starting to impact emerging markets has impacted the sector quite severely. However, if you look at resilient concerns, there's three main ones that they've addressed, and one of them is what they call the cross-holding structure. So you had a company called Fortress and Resilient that owned each other's shares, and that was the center of the allegations of price manipulation. They've consolidated their BE Trust, which was also alleged to be used as part of the price manipulation game, and the FSCA recently came out to clear the group of any share price manipulation. Having said that, the sector actually sold off about 31% last year, which was the worst year in the sector's history. And part of the reason that the SA REITs committee has embarked on a course to just improve governance and disclosure, which we'll touch on. This is Standard Bank's macroeconomic view at the moment. Our economists are expected to see fairly weak macro environment at the moment, and any recovery is likely to be protracted. So if you look at household consumption, which explains about 60% of our GDP, is expected to grow at about 1% in 2019 and 1.6% next year. And that's all driven on a Cyril Ramaphosa reform-driven agenda. I mean, that's what the view is, that our political analyst feels that Cyril Ramaphosa will at least stabilize some of the challenges that government faces in the hope to improve confidence in the broader economy. But if you look at GDP growth forecast, with Standard Bank, we're looking at 0.5% this year. And this is post the minus 3% shock in Q1 this year. Even in 2020, coming off a very low base, we're looking at 1.8%. However, economists feel that there's actually some major downside risks in the near term. Medium-term growth is expected to pick up, but that relies a lot on policy certainty to improve. Looking at the listed property sector, about 60% of the sector, when you exclude some of the offshore exposures, is actually made up of retail, which kind of talks to the fact that 60% of our GDP is driven by the consumer. So not a big disconnection there. However, if you look at trading density growth, and this is sales per square meter, that's come off quite sharply over the last few years, and currently is averaging about 2.5%. This is according to a study that was done by SAPOA themselves. And what we're finding is that the smaller, more convenient community centers are actually holding up a lot better than the larger regional centers. And this globally seems to be the case as well, if you look at UK REITs, which we'll touch on later. If you look at the listed property sector, trading density growth is actually quite weak, and it's mimicking what you're seeing in the direct property market. On average, the sector is averaging about 2.8%. Obviously, there's a company called Fairvest that included 3 large tenants in their number. If you look at their number, if you include those tenants, they're doing it about 0.5%. But nonetheless, okay, we'll give them some credit. Retail reversions. This is what rents you achieve when you renew space. At the moment, are screening negative for most of the big property funds. There's some that are doing positive numbers, but because of the weak trading, the cost of occupying space for retailers is actually rising. And when you take into account that escalations or rental growth in the property sector is averaging about 6 to 7%, given the weak growth, obviously that's not sustainable. So what's happening is that rentals are starting to rebase lower and lower, and that explains some of the weak performance we're seeing in the market. Here's a concern with South Africa. If you look at retail vacancies, are currently sitting at about 4.2%, and that's above their long-term average of 3%, according to SAPOA. However, a study that was done by SA Council of Shopping Centres not too long ago says that South Africa commands the 3rd highest retail exposure per unit of GDP. Okay, this is after US and Canada. And US retailers, and in the UK at the moment, retailers are getting absolutely smashed because of changing consumer habits, right? Because of e-commerce. So South Africa, yes, a big part of our economy is driven by the consumer, but we question whether isn't there too much retail supply structurally at the moment. And my concern personally is that even when the economy picks up and you see the advent of e-commerce coming into our markets, what you'll find is that changing commuter habits can actually start impacting negatively on retail, even if the economy starts to recover longer term. And that's something for some of the landlords to think about. Another thing is that there's still quite a bit of supply still coming into the market. The biggest one being Fourways Mall. Accelerate is adding about 100,000 square meters of space into their centers at the moment. You've got Koniba coming through in Durban. So at the moment, there is absolutely no catalyst to suggest that there's going to be improving trading as landlords obviously bring more space. And I make a last comment there to say SA retail is yet to see the impact of changing consumer habits, which we are starting to experience globally. Now, a big talking point in the SA REIT sector last year was Edcon and the challenges they were facing, which have been handled quite well, actually, by the landlords. So both the landlords and banks have agreed to a refinancing deal with Edcon trading struggling. Edcon only accounts for about 1.8% of the SAPI exposure, the listed property exposure. However, it was a big concern, and it was impacting valuations quite materially. Some landlords have actually agreed to a 41% rental cut for a 2-year period, okay? While some have actually chosen to subscribe for equity, which is a far more conservative and probably, some would argue, more rational option to avoid setting a precedent and limit contagion across the property REITs where other retailers could come and ask for a similar cut in rentals because they're struggling. Some REITs have actually taken back a bit of space from Edcon at the moment, or are expected to take about 20 to 40% of Edcon space that they currently occupy, and looking to relet in a fairly weak demand environment, which will be interesting to see whether this comes through. Looking at the office sector, this is a sector that's been under pressure for the longest of time. I mean, it makes up about 25% of the listed REITs, but vacancies have been climbing since 2008. And in Q1 this year, vacancies actually accelerated across all grades of office space in the market. Now look at prime, what we call peak grade or prime vacancies. In one quarter, that went from 6% to 8%. And as a consequence of that, annual rents have actually either remained flat or are going negative. Now, in real terms, office rentals have actually gone backwards 10% over the last 10 years or so. However, a new buzzword is all this co-working flexible office space that's at least expected to have some impact in anchoring office vacancies, although that's going to be small at the moment. I mean, this is some of the to-let signs that we see in and around Sandton and Rosebank. I mean, office incentives at the moment are quite high. Most landlords offer up to 12-month rent-free to let out space, and yet they still struggle to let out space. So the market is under a lot of pressure, and there's been quite a lot of office to residential conversions in the sector for a long time, but that has no impact on office vacancies at the moment, which we see as the biggest risk to the sector. What is even more concerning is that there's quite a bit of supply still coming into the market. A lot of that is actually focused in Sandton. So if you look at Sandton, accounts for about 26% of new office space in the market, according to a study that was done by Sapor themselves. Waterfall, about 16%, a lot of that driven by a tech, and then you've got Rosebank. So actually, about 56% of new supply is concentrated in 3 nodes in Johannesburg at the moment. And if you look at where vacancies are at the moment, Sandton is sitting close to 18% vacancy rate. And this is the new prime CBD node in Johannesburg at the moment. And we estimate that based on the supply that's coming up, vacancies could rise to about 20% in Sandton alone. And this is where most of the developments have been concentrated. Now, talking to some of the landlords, some of you are here, the claim is that, look, if you don't bring new, better quality office space, you're going to get your tenants cherry-picked by other office landlords, and that led to that self-fulfilling prophecy. And hence, you're seeing the office sector struggling so much. The chart on top right shows how much office space has been absorbed since 2003, and you can see that since 2009, none of the new supply has been absorbed. And hence, you're seeing vacancies having gone up. Now, if you look at Sandton, this is obviously the most exciting node in Joburg. That's where all of the developments are concentrated. But when you look at the older Sandton stock at the moment, what they call non-peak rate stock, rentals have actually declined about 4%. If you take into account incentives like rent-free periods that are offered by landlords, rentals are probably declined by double that. I would say close to 8% at the moment, which you cannot see visibly. And over the last 2 years, it's battled to absorb about 80,000 square meters of space per year. So that market will remain under pressure for some time to come. But the Sandton skyline has changed, and it looks quite magnificent, actually. I mean, the iconic Discovery building that Growthpoint did recently, you look at Sasol, who developed one of their main head offices, also located in Sandton, and the place looks quite impressive at the moment. These are world-class. Most of these are 4- to 5-star rated, and I could show you pictures of many of the buildings that have come online. But it's come at the expense of the sector. And then touching briefly on industrial, this is a sector that has enjoyed low vacancies for the longest of time. Rental growth is starting to slow as well, averaging about 4.6% in line with inflation at the moment. However, the weak Q1 GDP print could actually result in vacancies spiking. I mean, we're waiting to see the numbers for Q1 post the GDP print, which was quite disappointing. So in essence, if you look at the fundamentals of the sector is under pressure. There's too much supply coming through. How can you be optimistic even though the yields are attractive? If you look at the listed sector, we do something called like-for-like net income growth. This gives you a picture of how much your cash flows are growing. So if you look at headline rents in the market, they're either stable, in some cases rising. But when you look at the core income growth, it's actually working to around 3%. This is a sector that's charging 6 to 7% escalations for tenants. It just shows how much pressure there is in the market. Retail is doing about 4% on average in the listed space, still remaining reasonably defensive. And then you've got office, which is basically negative territory. Industrial, some portfolios have seen some big rental reversions, rentals going backwards by up to 20% in some cases. If you look at deal activity in the sector, there's a confidence crisis. I mean, this listed sector used to comfortably raise about 40 to 50 billion of equity per annum in the last few years. At the moment, we're already halfway through 2019 and the sector's already raised 2 billion. I mean, there's absolutely no activity. Though there's some activity in the direct market, that's also muted. And this is the bottom line, guys. I mean, you need the economy to grow for the sector to generate earnings. If you look at that change in demand for stock in the market overall, so when you look at the aggregate change in occupied space, and you overlay that with GDP growth, you can just see where SA is trending. Yes, there's some green shoots. If you look at liquidations in the market, which is the red line, and I've inverted that line just to show the correlation between the two and business confidence. And as long as business confidence remains below 50, there's nothing to be excited about at the moment. So there's literally no catalysts. So looking at listed property valuations, the light gray line or blue line, that's the yield on the South African 10-year bond versus the listed property yield. And I've excluded some offshore counters just not to distort the analysis. You can see that for the longest of time, the sector was actually trading at a premium to bond yields. So the lower yield means there's positive growth expectations in the market. However, the two lines have basically converged, and that's because of the sell-off we've seen in the property sector recently. This is how we value the sector. When you look at the spread of the sector, so basically the difference between these two lines, and you overlay that with property fundamentals, be it rental growth or vacancies, you can see those two lines, the blue line and the red line, are highly correlated. So if you think vacancies are going to rise, that blue line is going to rise, which means the sector will continue getting cheaper. And over the next 18 months, given our economic projections, we're just seeing the red line continuing to rise. Well, the blue line has risen ahead of the red line, but the point is that the sector is not necessarily cheap. It's actually tracking what's happening fundamentally. Another way to think of the blue line is to think of it as the risk premium that investors are willing to pay over and above the bond or the risk-free rate or bond yields. And that's going to continue to track property fundamentals. So in our view, the sector is actually fairly priced, maybe slightly cheap, but fairly priced, and it's also bottoming. Another way to look at that navy blue line that I was showing is to overlay that with what we call initial yields or capitalization rates. Now, if you look at the red line and that navy blue line, they've broadly moved in line with each other. However, our current view is that South African property valuations need to be impaired by about 10%. So in other words, your initial yields that investors are willing to pay is probably about 100 basis points higher than what's currently sitting on balance sheets of most companies. If you look at that red dot, we think cap rates should probably move closer to that, just to reflect the new norm, if you like, or the weak fundamentals. And as a result, when you look at this price to NAV, so this is a listed property share prices compared to underlying NAVs of the whole sector. It's currently sitting at 0.9 times, or if you like, the sector is trading at a 10% discount to NAV. But if you think cap rates need to move, which is our view at the moment, then the sector is probably trading around NAV. And hence drives our view that the sector is probably fairly priced. However, here's another concern. If you think valuations need to be impaired by, say, 10%, then these LTV ratios, which are averaging about 40% for the sector, are probably closer to, let's say, 45%, which is danger zone. So what we normally consider, let's say, a sound balance sheet are companies' LTV ratios between 30 and 40%. What concerns me personally is that when you look at a lot of capital that's been deployed offshore, the gearing levels or the LTV ratios are actually greater than 60%. In some cases, greater than 100% because some of those businesses have either struggled or something has gone wrong. So the underlying balance sheets in the sector is a big source of concern at the moment, especially if you believe valuations could continue to come under pressure. However, the sector is only 53% South Africa. About a third of the sector is in Eastern Europe at the moment. And when you look at Eastern European fundamentals, if you look at Poland, Czech Republic, Hungary, Slovenia, wage growth is outpacing CPI at the moment. If you look at the GDP growth forecast, they're averaging 3 to 4%, which is 3 to 4 times what you're getting in SA. And if you look at transaction volumes, these are emanating from USA, from Europe, from Australia into Eastern Europe at the moment. They're averaging about €1 billion a year. So that market is actually quite hot at the moment. However, there are some risks. There's some politics in Poland, issues that could impact growth going forward. There's concerns around the Polish economy. Now, Poland is now regarded as a developed country. It used to be an emerging country like us, but most are regarding it as a developing country at the moment. That market is actually overheating at the moment, some views out there. And global growth could slow. You know what Trump is doing. There's a trade war with China and so forth. However, this has actually helped the sector cushion the blow against weak SA fundamentals. Another positive in that much of the sector's total returns are driven by yield. So when you look at the total returns for the sector, say in the last 10 years, it's been about, let's call it 225%. But when you look at capital component of that return, it's about 54%. A lot has come from yield. And this is assuming that that yield is reinvested in the same companies. So just bear in mind that despite the weakness in South Africa, the sector has derated. If you look at that blue line, it's moved in line with fundamentals. In fact, in some cases, it's moved ahead of fundamentals. So the yields are starting to look very attractive. And given that the sector's big component of return is driven by yield, it's actually worth having a look at this point, although that depends where Cyril takes the country going forward. Lastly, there's a lot of work being done to improve governance in the SA REIT sector. There's a second draft of the SA REITs best practice that's currently in circulation for public comment. I know Bram at Equitas, STN, and a few other guys are actually spearheading this. And it's going to address a lot of the metrics that we as analysts use to compare companies. It's going to make them more uniform, improve disclosure. And given what happened last year, I think it's actually a positive for the sector. So, in essence, it is tough. But if you're looking at the listed market, the pricing, a lot of the pricing is actually already reflecting the weak fundamentals. Now, if you've got a positive call in South Africa, this sector is probably screaming buy, especially when you look at what drives total returns in the sector. Thank you very much.
So I think, Bandi, you've obviously touched on a number of very interesting topics that are facing the listed property sector, not only the listed property sector, but also the property sector in general in South Africa. I think I'd maybe like to just to kickstart a general question to the panel. Any sort of initial observations, comments, perhaps from yourself, Estienne, following Bandi's presentation.
Yeah, I think Bandi obviously has a very good understanding of what's happening in the sector. He's been around a couple of years, as have some of the colleagues down the row here. We have seen better times, and I think that there are certainly some of those green shoots that one can allude to, but the reality is we are facing the most difficult economy that certainly any of us have ever faced in our careers in the real estate sector, certainly in South Africa. So some of the things that happen are really as a function of that. And I think there's certainly aspects that we can improve on as a sector, and I think we'll touch on that a little bit later.
Yeah, thanks, Craig. I think Bundy's presentation was good. Clearly, some of the issues or risks that Bundy has mentioned are self-inflicted by the sector. He spoke about issues of governance and the likes. I think obviously there's a lot of turbulence in in the sector at the moment. Particularly with a few counters, with management issues, board issues. All of those don't instill confidence with investors. Obviously, they make them extremely nervous. But the other major issue is political risk. Certainly, as one of the funds that is hugely exposed to government, we see that coming through quite a lot, and it's something that obviously has had a detrimental effect, particularly in a fund like ours. I think the last point I'd like to make is probably the scarcity of financing, of debt. Banks have become extremely shrewd in terms of providing debt financing. They can see that the sector is obviously being squeezed. Debt funding is obviously becoming a bit expensive, and you definitely don't want to be on the wrong side of that curve.
If I look at Bundy's presentation, I think the most important graph on that presentation is the GDP growth or lack of GDP growth that we're currently seeing within the sector. And thus far, I think in general, our view is that property owners have been benefiting from good cost management on the one hand, and also by cutting rentals and keeping buildings full. But if we continue to have lackluster growth, and I think the chance of us having anything above 2% to get growth back is very limited. So if we continue to have that lackluster growth, we will see a hit on vacancies. And as soon as you see that hit on vacancies, where you don't have the benefit of at least have a tenant in the building, we could see further pressure within the sector. So unless we see a return of economic growth or proper economic growth, this doldrums will continue within the sector, and the risk of rising vacancies.
Cool. Evan?
I think Bundy's overview very much accords with our thinking. Looking at these chart about valuations from a lister's perspective, it's very hard to understand why cap rates are at the rate they are in physical property. It's remained a mystery for quite some time. And maybe just on one of these charts, which showed you the yield, just another perspective, the yield on this chart for listed property now is about 10%. A few years ago, it was 6 to 7%. So what it says, in other words, property dividends can fall 30, 40% before you're in the same position cash flow-wise as you were a few years ago. Of course, the growth outlook's very different, the risk outlook's very different, bond yields are different levels, but I think that's an interesting perspective of how things have changed in terms of pricing in the listed property space.
And maybe just a question for both Evan and Anton, just given your vantage point being allocators of capital or working for asset managers, maybe just your sort of views how property as an asset class is currently viewed from your colleagues and that manage across various sectors as well.
I mean, I think the generalists, I think, have always been pretty skeptical of the property sector. Recent governance hasn't helped in that respect. I think are definitely improving. And I think listed property companies going offshore, while that certainly makes sense from a company perspective, doesn't fill generalists with lots of confidence, given that South African companies don't have a great track record offshore. Listed property companies so far have done a lot better, I think, than many other sectors. But I think there is a bit of a dark cloud from a generalist perspective that I sensed for property.
Yeah, I would agree with Evan there. From our side, when you look at listed property, most people, from an asset allocation point of view, compare it to bonds because of the yield component within the total return, as Bundy pointed out. The thing in the past that sheltered the property sector versus bond debate was always the growth in dividends that one can expect. If you go back to the mid-1980s, the sector has given you around 6% average dividend growth per annum. The last 10 years, that was 8%. Last year, it was 5%. Year to date, it was between 1 and 2%. So without that dividend growth, as capital allocators are not going to look at the sector because that's the main reason or the alpha element that they look within the sector. Another thing that's very important is what I heard last week, the term capital liability that sits within the sector. Because most of the companies within the sector are REITs, they pay out 100% of their earnings. They don't depreciate assets as kind of normal companies do, and therefore the kind of AFFO or adjusted earnings that you need to calculate to compensate for the capital that you need to spend to keep your properties or just to maintain your properties are not taken into account. So therefore that capital liability that sits in your balance sheet that you some other time need to pay because you need to have that skin in the game with the property itself, that's going to start hurting the companies, and we're already seeing that coming through over the last 2 to 3 years. So for us, that's a big risk within the sector, and I think a lot of people just focusing on the yield, you remember that yield may be high, but that yield can go down, not because of a re-rating in the price, but because of the actual earnings going down. And that's what we're currently seeing within the sector.
And maybe, Anton, on that point, I mean, how do you, comparing the SA market and how the SA market prices listed property versus other markets, I mean, do you see any similarities or any differences specifically on that aspect?
I mean, the themes that are playing out globally are definitely playing out in South Africa in a similar way. On a global level, retail REITs or retail property companies are definitely not in favor. If you look at some of the US and European names, similarly in South Africa, we all know that a lot of people are shining away from investing in the retail space at the moment, and logistics or self-storage or even apartment REITs in the US and also in Europe and Australia are the ones where they are receiving investor support. Similarly in South Africa, with those stocks receiving investor support. So it's very similar themes that we're seeing locally and globally.
Great. And then maybe, Estienne, a response from your side as a landlord, I suppose, in terms of industry initiatives. Obviously, Bandi touched on the BPR, which is currently underway. Maybe just give some color in terms of what some of the items on the agenda are and some of the initiatives to restore confidence back into the listed property sector.
I mean, I think as an opening comment, what is quite unique to the sector is, you have one or two companies that have, let's say, governance issues, and all of a sudden the whole listed sector is branded as pariahs of corporate South Africa. I don't see the equities counters selling off because Steinhoff went bad, and as a result, everybody is now a pariah of corporate governance. So I think, it is isolated issues, but I think from the SA REIT Association's point of view, what we have done is after the legislation came in 2013, we asked the Accounting and JSE Compliance Committee to come up with what we had hoped would be a standardized reporting framework. So the best practice recommendation in terms of how we communicate to the market. This document was produced, and I think it was quite well received, but it was very much the first phase. Clearly, having gone through 5 years of growth in the sector, unprecedented growth in terms of internationalization, there have been quite a few different dynamics that have come through, and it's become increasingly difficult for these guys, the analysts and the investors, to try and analyze the numbers. So if Redefine talks about a specific rate of retention and Growthpoint talks about a specific rate of retention, I can promise you we're calculating them totally different, because he's getting 96 and I'm getting 68. So I just know it's wrong, and those are the kind of things that we have to standardize for the sector, right? So this initiative will help the analysts and investors analyze the sector and understand the sector better. Where a lot of damage has been done because of this narrative of governance in the sector is with general equity investors. And what we are doing as SA REIT, and some of the CEOs will be undertaking a bit of a roadshow. So clearly the listed property investors are very au fait and have a very good understanding of the sector and all the dynamics and the individuals in the sector. But the general equity guys don't have time for that kind of detail. So they just hear a story, listed property is down and out, and guess what, we're going somewhere else. So that's clearly not a good thing. We need the capital as a sector. And in fact, what we're trying to deliver is predictable returns rather than necessarily growing in this environment. And ironically, if you go and look over the JSE, there aren't that many companies growing, surprisingly, in this economy. So actually a predictable return isn't such a bad thing. So I think that education of general equities investors from the SA REIT side, together with the efforts of SAPOA, will certainly help a lot.
Right. And yeah, maybe.
If I may just add there, Craig, I think looking at the draft best practice document, the second edition, is that, my experience, I used to cover insurance sector, where you have to model mortality, when people are going to die, and all sorts of things before you can actually predict earnings.
Might be like that in the listed property sector soon too.
I thought property was actually easy. You just collect rent and you pay expenses and that's it. So it is the one sector that doesn't trade on what you call IFRS earnings. Okay, it trades on what you call distributable earnings, which is what the landlord decides. And I picked up in the second best practice document is that there's actually a requirement for the auditor to sign on that. Let's call it reconciliation from your cash flow earnings that you generate in the business to what you actually declare as distributions, because property is quite unique in that sense, in that it doesn't trade on your IFRS earnings. And I can see that there's auditors are going to start signing on some of the, let's say, core metrics that investors look at to trade in the sector, which I think is a huge, huge positive.
Great. So I think maybe turning away a bit from some of the governance issues which have been facing the sector, I think maybe just to turn towards some of the property fundamentals and how the SA REIT sector is positioned from an exposure point of view. I think a question I'd like to pose for Anton and Evan is around, I suppose it's the perennial, discussion, debate around offshore versus local. I suppose in the context of local listed property counters, appearing to look cheap relative to what's playing out on the direct property side. Maybe just your comments, observations in response to that common question.
Yeah, I think what's important is to look at what is the quality of the earnings that listed property counter that you may look at to invest in, actually deliver. Because what we've seen over the last 3 or 4 years is initially a ramping up of earnings based on non-traditional property type income streams. And although we are seeing some rebasing, as we speak now, I still think there should be continued rebasing over the next year or two, that the focus is on the pure fundamentals of that counter. And therefore, although it may seem cheap, it is not as cheap as what it may seem, as Bandi pointed out, because there are ways and means where the distributable earnings are actually, I wouldn't say manipulated, but it's if you're a general equity investor, you would ask yourself, but what is the antecedent dividend, as an example? Now, although we're familiar with that within the sector, it is your general equity investor is not familiar with something like an antecedent dividend. So those kind of things need to play itself out before, one can say with confidence that earnings that I'm receiving is your pure property earnings, and it's based on the fundamentals of the underlying sectors where the stock is invested in.
Evan?
No, I think, look, the risk profile is changing. The market is more skeptical of looking at numbers. The international acquisitions are adding levels of risk that weren't there before, specifically funding risks. So things that I don't understand, what happens in European markets, which I don't have a strong handle on, but if European interest rates were to rise significantly, and that's not what's happening at the moment, and some of those fixes on European debt or swaps on them rise significantly, you can have big pressures on distributable numbers because of that. And those are factors into the future, but there are new risk factors, I think, into the asset class, but those risks also come with advantages at the moment too. It's not a one-way bet, but it's a far more complicated sector than it's been before, and I think the market may want to price for some of that complexity that's growing.
Right. And then there's obviously been a growing trend in the property sector in general, specifically in the listed property sector, for companies to make investments in what would be considered alternative sort of property sub-asset classes. I think Growthpoint has recently or fairly recently launched their fund management business and has also launched their healthcare business. I think maybe just signs of pockets of opportunities in the market. I mean, Estienne, I know Bandy's obviously given the context of the SA economy and the SA property sector, looks to be in a fairly tricky space. I mean, what opportunities are you seeing in those particular opportunities?
So I think in an environment which is in South Africa quite difficult, we embarked on a strategy to see where there are other income-generating opportunities which we could just leverage off our existing infrastructure. And one of those was collaborative workspace. So we've got an investment in a company called Workshop 17, which is probably one of the largest collaborative workspace businesses today. They have offices in Cape Town, in Johannesburg, Rosebank, etc. And that's been quite an interesting trend. I think it's also a theme that's coming through in the office space environment, which offers a bit of flexibility. On the fund management side there, our first initiative was to create counter-cyclically a bit of an Africa investment opportunity. Certainly internationally there is demand for investments north of our borders. And we certainly have a view that the cycle where it is now, it's a better time to buy than probably to sell. And over the long term, those economies will grow, and those investors in those funds will certainly benefit from that. The healthcare space is pretty well trodden internationally, so even though we've got one of the most developed and sophisticated listed property sectors globally, there are certain niches that we haven't got represented on the JSE as such yet, and we believe that over a period of time, certainly the demand in our country for quality healthcare facilities is a huge opportunity. And with the environment, which is quite difficult for emerging operators to get the funding to build hospitals and medical facilities alike, there is an opportunity for a capital partner like ourselves, if you'd like, and investors into that sector to try and step up into that space. Certainly the one area that's proven to be very successful is also the storage investment space, and I think internationally we've seen, with the urbanization of people, that sector will continue to grow.
Great. And Sandile, a question for you on the direct property side. As a business that's firmly rooted in South Africa and the continent, I mean, your sort of experience in sort of the current environment and looking forward over the next 12 months, what do you see playing out?
Yeah, thanks, Craig. I think we've proven one of the theories that you can definitely not run a property or a REIT without any leases. So I think that it becomes extremely difficult. I think the challenges that we've obviously had have been mostly focused on our big tenant. Thankfully, that seems to have bottomed itself out. I think we are on the growth trajectory now. The leases are coming through. The next phase for us where we see opportunities, obviously, we have to spend a lot of capex in these properties. Some of the properties that are in the nodes that we play in haven't seen significant capex, for 2 or 3 years. I think that definitely is something that we are focusing on. But I think also what the current environment has created is obviously there's been a lot of players there. We do see some potential for consolidation there. I think you do need 1 or 2 companies with very, very strong balance sheets to make sure that they can take the knocks that come with that particular long decision making, basically, that comes with a sovereign underpinned space. And then just maybe on the last point is the associated with it is that what do you do with these inner city buildings that are there potentially? You could see re-tenanting those buildings with student accommodation and the likes. There's a statistic that there's something like 80,000 beds shortage for the higher tertiary education. So I think that could be the next phase that one can go there. But at this point, all our effort is basically inwardly focused. We're basically focusing and making sure, as Bandi mentioned, companies with stronger balance sheet, if we can bring the debt below 40% is a big focus point. I think for us, obviously, the cost of debt is a major challenge, and I think that will improve over time.
Great. Bandi, and a question for you. I mean, what would you see as some of the missing ingredients for potential M&A in the listed property sector, looking ahead towards the rest of the year and into 2020?
Missing ingredients.
Correct.
We need more investor participation. As I said, I think, in my experience in the sector has matured. It comes off a low base. Redefined growth pointer in the top 40 now. I think the landlords have squeezed as much for investors and shareholders as they can get, and that's why you're getting all this rebasing happening. You've got guys planting money offshore in search for growth, but the same companies would plant money in South Africa if they had policy certainty. For me, I just look at the listed property sector and saying, look, I think it's done reasonably well. As I showed, total returns in the last 10 years have been fantastic, actually. It suffered in the last 18 months, and there's some governance issues which the likes of SDN are addressing. But a bit more policy certainty. There's a willingness to invest in South Africa. Look at how Sandton looks at the moment. That skyline is quite impressive at the moment. So, a bit more policy certainty, a bit more political will to create an investor-friendly environment could help the sector quite a lot.
And Estienne, as one of the larger property owners and listed property companies, or the largest, any comments?
I think, there are certainly some green shoots. We're seeing in the South African environment, Cape Town and Durban still remain quite solid markets. We don't have as much weakness in those markets, and albeit that there's been a protracted period of weak growth, which does spill out into specifically the office space. In the industrial space, there is still certainly a little bit of activity. On the certainly big picture from a listed property point of view, I think returns are still very predictable in terms of what's being communicated to the market. I think Growthpoint for a couple of years has won the IS award for disclosure, and so there are sort of a couple of green shoots in terms of governance, in terms of communicating to the market, and that's not just for the listed property sector, but for the whole JSE. So we do endeavour to communicate clearly to the market, and I do believe that as a sector, the skill sets in the sector are really strong. South Africa has very clever people that can operate in complexity that nobody in the rest of the world can trade in. Let me tell you that, in terms of the difficulty that an executive in a South African environment has to trade in, and the stuff we have to worry about, the guys in Europe don't even know about. So the reality is with all that complexity, it gives us certain skill sets which you can export, and certainly we have successfully done so. And those returns all come back to South Africa. I think obviously our priority is here, and it is to grow it. And it's also not all that great across the world. If you're in the UK today, you were in Amazon or Intu or any of these stocks, trust me, you would have burnt much harder than you would have burnt in Growthpoint. So I think the reality is there are certainly things that we're doing well. I think there's things we can do better. And, if the economy grows, we'll definitely all benefit.
Great. I think we are running out of time. So last question, one-word response from the panelists. Your views looking forward 12 months compared to this time last year, looking forward 12 months on South Africa? Positive, negative, neutral? Bandi, starting with you.
Neutral.
Estienne?
Yeah, I think it's going to take a little bit longer, but I think positive will be eventually the case.
I think from me, cautiously optimistic. I think, we obviously have been through, I think 2018 was a bloodbath for everybody. I think it can only get better from there, but the results will be in the pudding, so to speak.
Yeah, I think neutral with a wait-and-see approach. So you can see who's the entrepreneurs who's optimistic and who's the people that's sitting behind the spreadsheets.
Always easier to run your business on a spreadsheet. Change cell C4 to up the margin.
I always hope the listed property sector is more a function of the economy than property-specific or company-specific bad news. I think there's been a lot of bad news that's happened, and hopefully we can run with the economy now, which is slow, but less better than some of the large negative surprises we've had. And it's been quite a negative discussion, but some things are improving. Building plans passed are down quite sharply. So with less supply coming in, I mean, things will be eventually absorbed, so some of the headwinds are receding in physical property as well.
Great. Thank you. Thanks very much.